Welcome back to the course on International Financial Management. In today's lecture, we are going to discuss a very important topic, which is fixed versus floating exchange rate system. Before we understand fixed and floating system, let's first look at how the global monetary system evolved. We start with Bretton Woods system, where exchange rates were fixed. The US dollar was pegged to gold and the other currencies were pegged to the dollar. The IMF played a supervisory role. Then in 1969, special drawing rights or SDRs were introduced by the IMF to increase global liquidity. However, the system began to collapse when the US suspended dollar gold convertibility in 1971. This is known as Nixon shock. Finally, in 1976, the Jamaica Agreement formally legalized floating exchange rates and revised the IMF's role. Now, an important question is, why did SDR fail? The key reason is that they could not solve deeper structural problems like over dependence on the US dollar and persistent global imbalances. So, the ultimate result was a shift from fixed to floating exchange rate system. Let us now understand what a fixed exchange rate system is. In this system, the value of country's currency is pegged to another currency or sometimes to the gold. The central bank actively intervenes in the foreign exchange market to maintain this fixed value. Let us first look at the advantages. A major advantage is that it reduces uncertainty and price instability. Since the exchange rate remains constant, businesses can plan international transactions without worrying about fluctuations. Second, it eliminates foreign exchange uncertainty for traders and investors and reduces transaction cost as there is no need for hedging. Third, it also attracts foreign investment because investors prefer stable environment. Another important benefit is that it prevents competitive devaluation among countries. Fixed exchange rates also provide a nominal anchor, which helps in maintaining monetary discipline. Further, it facilitates deeper economic integration. For example, the Eurozone countries benefit from stable exchange rates. Finally, countries with a weak monetary track record can borrow credibility by pegging their currency to a stable currency. However, a fixed exchange rate system also has significant disadvantage. The most important drawback is the loss of monetary policy autonomy. The central bank cannot freely adjust interest rates because it must focus on maintaining the exchange rate. This system also requires large foreign exchange reserves as the central bank must constantly intervene in the market. It is vulnerable to the speculative attacks as seen in European monetary system crisis of 1992 and the Asian financial crisis of 1997. Another issue is misalignment. If inflation rates differ across countries, the fixed exchange rate may become unrealistic. Further, countries cannot easily respond to asymmetric shocks. They cannot devalue their currency and must instead adjust through internal deflation, which can be painful. Finally, maintaining a fixed exchange rate becomes especially difficult when there is a high degree of capital mobility. This is related to the well-known impossible trinity or trilemma. So, because of these limitations, especially the loss of flexibility, and the pressure on reserves, the fixed exchange rate system could not be sustained globally. This led to an emergence of a floating exchange rate system. In floating exchange rate system, the value of a currency is determined by the forces of demand and supply in the foreign exchange market. There is no fixed parity and the central bank does not intervene continuously. One of the key advantages is that it helps correct trade imbalances automatically. Now, let me give you an example of Indian exporter. Let us suppose there is an Indian exporter who sells goods worth rupees 10,000. So, this is in rupees, right, 10,000. Now, the exchange rate is $1 equal to 80 rupees. Now, the importer pays $125, that is 10,000 divided by 80, this gives us $125. Now, this importer is the US importer. Now, let us say that after some time $1 it appreciates and it becomes equal to 100 rupees. Now, in this case, what is going to be the payout of US importer? Now, here the US importer is going to pay 10,000 rupees divided by 100 rupees, that is $100. So, the export has become cheap for the US importer, right, because now he is paying how many dollars less? He is paying $25 less, and the Indian exports has become less expensive, or we can say has become cheap. This will increase exports. Another advantage is that countries do not need to maintain large foreign exchange reserves. There is minimal government intervention and exchange rates are determined by market forces, leading to efficient allocation of resources. Floating exchange rates also provide full monetary policy autonomy, allowing countries to focus on domestic economic conditions. They act as automatic shock absorbers and are less vulnerable to speculative attacks. In the long run, exchange rates tend to reflect economic fundamentals. However, floating systems also has disadvantage. The most obvious one is exchange rate volatility. Exchange rates can fluctuate significantly in the short run, creating uncertainty and making planning difficult. This uncertainty discourages trade and investment because firms cannot predict future cost and revenues accurately. There is also a risk of imported inflation if the currency depreciates. Currencies may engage in competitive devaluation, leading to currency wars. And due to currency wars, there can be a loss of monetary discipline. Most importantly, firms now face exchange rate risk, which makes financial management more complex. Now, this brings us to an important concept: foreign exchange risk. It refers to the possibility that exchange rate fluctuations may adversely affect financial transactions, assets, or future cash flows. This risk can be classified into three types: transaction exposure, translation exposure, and economic exposure. Let us understand transaction exposure with help of an example. Let us take the example of an exporter. This exporter is expecting $1,000 from his export, and he will receive the payment after 2 months. Now, let us say that when he made the contract, then $1 was equal to 82 rupees. Now, he received $1,000. Now, this is what the exporter is going to do. The exporter will convert it into rupees. So, at the time of the contract, when he entered into the contract, $1 was equal to 80 rupees, fine. So, $1 was equal to 80 rupees, and hence he will receive how much? He will receive 1000 into 82, which is 82,000. But if the dollar depreciates, let us say $1 now becomes equal to 80 rupees. Then after 2 months, this is after 2 months, the dollar has depreciated. Then after 2 months, $1,000 will be converted at a rate of 80 rupees and will fetch the exporter only 80,000 rupees. So, he incurs a loss of 2,000 rupees just by the change in the exchange rate. Next is the translation exposure. This arises when multinational companies convert foreign financial statements into their home currency. Now, this happens because multinational companies have subsidiaries at various different countries, and when the consolidated financial statements are made, then the financial statements of the subsidiaries have to be translated into the home country's currency, where the head office of the multinational company is. Now, for example, assets worth $5 lakh may be valued at £4 lakh initially. If the exchange rate changes, the value may fall to £3,75,000. The result in a loss, but only on paper. There is no actual cash flow impact. Economic exposure refers to the long-term impact of exchange rate changes on the firm's competitiveness, revenues, and cost. It affects the entire business. For example, if a currency appreciates, exports become expensive and demand falls. If it depreciates, exports may become cheap and they may increase, but the import cost or the input cost may rise. A classic example is Laker Airways. Laker Airways was a British airline offering low-cost flights between the UK and the US. In the late 1970s, the US dollar was weak and making travel to the US cheaper for British tourists. So, this increased the demand of tourism in United States. Now, to meet this increased demand, the airline expanded its operations and financed its expansion through loan in US dollars. So, its revenue was in pounds while its liabilities were in dollars. When the US dollar started appreciating in early 1980s, two major problems arose. First, the cost of repaying dollar loans increased. This created transaction exposure. Second, travel to the US became more expensive, reducing demand. This created economic exposure. So, cost increased while the revenues decreased. This mismatch eventually led to severe financial distress, and Laker Airways went bankrupt in 1982. This example shows that exchange rate changes can affect not just individual transactions, but the entire business model of a firm. Now that we have understood the three types of foreign exchange exposure, which are transaction, translation and economic exposure, let's compare them to understand their differences more clearly. First, let us look at the duration. Economic exposure is a long term in nature. It affects the firm over the entire life of a project or business. It is not limited to a single transaction, but influences future cash flows over many years. Transaction exposure, on the other hand, is short to medium term. It exists only for the duration of the specific contract until the payment is made or received. Translation exposure is even more short term in nature. It arises at a particular point in time, mainly when financial statements are being converted from one currency to another. Next, consider gain or losses. In economic exposure, the total impact is difficult to measure. It affects the overall business performance, including sales, cost and competitiveness. So, the exact gain or loss is not easy to calculate. In transaction exposure, gains or losses are real and can be calculated relatively easy because they arise from specific contractual cash flows. In translation exposure, the gains or losses are not only on paper, they arise due to accounting conversion and do not involve actual cash flow, making them easier to compute. Now, let us look at the nature of the contracts. Economic exposure is general in nature. It is not tied to a specific contract, but affects the entire business environment. Transaction exposure is specific. It arises from clearly defined contracts such as imports or exports agreement. Translation exposure is also specific, but it is related to accounting requirements and consolidations of financial statements. Next is measurement. Economic exposure depends on variations in actual future exchange rates and how they affect the firm's operations, making it complex to measure. Transaction exposure depends on the changes in actual spot exchange rates between the contract date and the settlement date. Translation exposure depends upon accounting guidelines and the exchange rate used for conversion rather than actual cash movements. Let us consider hedging. Economic exposure is the most difficult to hedge because it involves long-term and uncertain factors. Transaction exposure is relatively easy to hedge because it involves specific and known cash flows. Translation exposure is the easiest to manage as it is mainly an accounting issue and can often be adjusted through accounting techniques. If we consider the value that is affected, in the case of economic exposure, we are concerned with the market value of the firm's asset. This means how the overall value of the business is affected in real terms due to exchange rate changes. In transaction exposure, the focus is on the contract value of the assets and liabilities. These are specific amounts that the firm has to pay or receive under a contract. In translation exposure, we deal with the book value of the assets and liabilities. These are accounting values that appear in financial statements after conversion. Now, let us look at the extent of the exposure. Economic exposure is influenced by broader market forces. It is guided by both product markets and the factor markets. This means it depends on demand, competition, input cost and overall economic conditions. Transaction exposure is more limited in scope. It is determined by the nature of specific contracts entered into by the firm. Translation exposure depends on accounting rules and standards. The extent of exposure varies depending on how financial statements are prepared and converted. Finally, let us understand the management of exposure. Economic exposure requires involvement from the entire organization. All departments such as production, marketing, finance and strategy must work together to manage it because it affects the overall business. Transaction exposure is usually managed by Treasury Department. Since it involves specific cash flows, it can be handled as financial instruments like hedging. Similarly, translation exposure is also managed by Treasury or Finance Department, mainly through accounting techniques and financial adjustments. So, if we look at the broader picture, economic exposure is strategic and affect the entire firm. Transaction exposure is operational and linked to specific contracts, while translation exposure is accounting based and affects financial reporting. Now, let us conclude this lecture. The collapse of Bretton Woods and the inability of SDR to sustain fixed exchange rate led to the adoption of floating exchange rates under the Jamaica Agreement. Now, fixed exchange rates provide stability, but it lacks flexibility. Floating exchange rates provide flexibility, but it introduces uncertainty and risk. Now, managing all types of exposures, all the three exposures which are transaction exposure, translation exposure and economic exposure becomes a key function of international financial management. Thank you for now.